Okay, everyone. Well, welcome to the Psychos Bank Bright Ideas WebEx series. My name's Jason Hamilton. I'll be hosting your way through this. I've got David Brooks, also out of our Cincinnati office, that will be taking you through the market commentary, economic overlook, and I'll cover the second half of that, just talking a little bit about what we would expect with estate planning and taxes if we were to see a change in presidency. And I do want to preference today kind of how we've come up with this deck of slides for you to see, hopefully, if you came in on the computer. But if you're listening, it's by no means biased towards a Trump or a potential President Biden. It's really directed at we know what we know with President Trump. If he remains in office, there's little things that would change, and there's not many things that would be unsettling to the market. With a President Biden, there's a different story to his presidency, and that's kind of what we've geared some of our talking points off of, is how would that change for an investor, one of our clients, whether it be how we're managing portfolios or estate planning or looking at tax efficiencies within your own household. And that's the point of today, is just to take you through what some of it might look like pretty extreme. It's a worst case scenario, and we'll talk a little bit more about how some of these things could potentially play out and what would stop some things from playing out. And I'll probably cover more of that after David has gone through. But once again, appreciate everyone tuning in. I'm going to let David kick it off and go through that. Like I said, we'll save questions for the end today again. And you can chat those questions if you came in online. And if you're on the phone, a *6 or however you unmute yourself, but *6 would generally work. You can ask a question that way. So with that, I'm going to go ahead and get started, hand it off to David, and we'll go from there.
Thanks, Jason. Great to be with everybody today. Hopefully we can provide some good information. As Jason said, we have a lot to cover, so I'm going to be sharing my screen here, and hopefully it works well. One of the things that I did want to take a moment to do is to thank a few people in our Louisville office for some assistance in helping me organize these slides. Keith Blakely, Damon Massey, Greg Watkins, Gina Slayton with some great election information have assisted me, so I just want to say thanks to them. So again, this is a long presentation, so we're going to get right to it. So hopefully you can see these slides. Jason deserves credit for our title, 2020, The Highlights of a Real-Life Horror Story. This has been a year that I know many of us just want to have over, but obviously we're doing the best we can, and hopefully today we can give you some insights into the financial markets and a lot of the items that are taking place. So let's get started. So COVID has changed so much about our daily lives. I think we all know, unfortunately, that how we work, how we shop, how we teach our children, how we eat, how we socialize, unfortunately all of this has changed dramatically. What about our financial markets? That's obviously what we're here to talk about. Well, some interesting statistics I have up on the screen. Again, I know some of you are just listening, so I'll try to give you an overview of what we're covering. But since COVID arrived early in this year, there's been some interesting things take place, and I just thought I'd share a few things to kind of lay the table, as it were. In early February, Apple's stock was trading around $80. Now that's split adjusted. It did split this year. Now it's around $120 per share, and I realize this morning it might be down a little bit. But the point is, Apple stock is worth more now than it was before the pandemic. On the flip side, Delta Airlines stock, Delta is a company that has a hub up here in Cincinnati and affects our local economy, so we tend to follow it quite a bit. That stock was trading around $60 a share, and now it's trading around $30 a share. So just in those two stocks, you can realize how the pandemic has benefited some areas of the economy, but obviously been very bad for other parts. Now, likewise, an interesting stat here is in early February, mortgage rates were around 3.5%. The 30-year rate now is about 2.75. So due to the actions of the Federal Reserve and the way the market has evolved, borrowing costs have come down. So that obviously has been a positive. So it's been an interesting year to say the least. I've included a brief chart here that shows that the Dow, before COVID arrived, which is the blue line on the chart, was trading just under 30,000. And then on March 23rd, about 4 weeks after it started to drop, it hit a bottom at about 18,500. That's a loss of about 37%. But this next chart shows you that it's been an amazing recovery in stocks. So stocks bottomed in March, but in just over 5 months, the Dow recaptured almost all of what it's lost. Now, this is only through September, so prices have fluctuated a little bit since then, but it has been quite a recovery. And that's one of the things that Jason and I wanted to touch on today. The overall economy, as this slide shows that we're still struggling. If you look at the pandemic and when it arrived in the spring of this year, 22 million jobs were lost. Now, that relates specifically to the pandemic. As of the October monthly jobs report, we'll get the November one next week, we were still down 10.7 of the 22 million. So we've recaptured about half, which is great, and that's positive, but we still got some heavy lifting to do to get back to where we were. The unemployment rate stands at just under 8%, which is still quite high, but it was up above 14%. So again, we've definitely seen some recovery take place. Now, certain industries, as I've listed here, airlines, travel, leisure, restaurants, and others are still struggling. And recently, as we all know, unfortunately, COVID-19 cases have been rising. But the hope is the virus may be becoming a little less deadly, and we're obviously all watching that and praying that that is the case. So the overall economy is not back to where it was. And this chart here shows that by certain sectors, employment has struggled. For instance, on the left-hand side, as you look at this chart, you'll notice that leisure and hospitality lost a little more than 8 million jobs, and so far we've recaptured 50% of that. Still a ways to go. Likewise, as you look at the bottom, you can notice trade, transportation, education, health services, those have dropped and are still recovering. Meanwhile, on the right-hand side, information technology, financial services, those areas have not been affected as dramatically. So why has the stock market done so well, even though the economy is still struggling to return to where it was? And that's one of the things we want to talk about today. Well, one of the reasons is a massive stimulus program, and I'm going to spend a little time on this. Now, this chart that you might, hopefully you can see, again, if you're just calling in, I'll take you through it, shows that the Fed's balance sheet dropped to around just under $4 trillion in September of 19, meaning about a year ago. So this, in the spring, and this chart shows you in March, that the Fed's balance sheet exploded up by about $3 trillion. Listed on the chart are a bunch of the historic money stimulus plans they introduced. I won't bore you and read those to you, but the Fed was Johnny on the spot and came in quickly and injected $3 trillion through balance sheet expansion. This next chart, updated through the end of September, shows that the Fed has maintained its ultra-accommodative stance. The balance sheet stands and continues to stand at around $7 trillion, and they have a lot more power to use here if need be. Jerome Powell has done several WebExes where he's shared with people that he will continue to be ready to provide support as needed. The balance sheet of the Federal Reserve, which this next slide shows, has a lot of treasuries on it. It also has some mortgaged-backed securities, as well as some corporate bonds and other holdings. The Fed at this point has come out and created so many ways for them to support the bond market and the financial markets that which assets they'll hold on this could continue to evolve as needed. Now, if you take the Fed's program, which was, again, about $3 trillion of balance sheet expansion, you can add to that $2 trillion that the federal government has introduced through the CARES Act. You might recall when that took place back in the spring, $1,200 checks were sent out to support consumer spending and provide support to people. Unemployment benefits were increased significantly. And we had the introduction of the PPP program, the Paycheck Protection Program, which provided forgivable loans basically to cover 8 weeks of essential cost. This was a key piece, and I know not only our bank, but many banks saw an increase in demand. So this program of $2 trillion was further stimulus to provide support. Really, if you step back and look at it, and this next slide shows that, it was a reaction like no other. The central banks generated about 7% of GDP through their efforts. Europe, as well as Japan and other countries followed suit, and the fiscal stimulus was huge as well. So if you really think about it, and this is where I want to pause and really try to help you visualize how much $5 trillion is. It's a lot of zeros. It's 12 if you count them out. So I thought I'd go through a little fun visualization of what that means. So this next chart shows you've got a $100 bill and then a stack of $100 bills, which represents $10,000. I think we can all kind of visualize that. This next slide shows what $1 million would look like. It's quite a stack of $100 bills. And then you've got $100 million bills visualizing here, a pallet of $100 bills next to a couch made out of $100 bills that a lady's enjoying herself on, and it's quite a lot of money. That's $100 million. But then let's look at $1 billion. The gentleman's joined her now. We've got 10 pallets of $100 bills stacked about 5 feet high, and that's just $1 billion. So what is a trillion? Well, here's $1 trillion. And for those who can't see this, I'll try to explain it. You've got rows and rows and rows of pallets of $100 bills lined up in front of the White House. And on this visualization, it shows the White House, not just the main residence, but the East Wing and the West Wing. And for further context, a football field and a 747 down there showing you how much $1 trillion is. And by the way, our stimulus program was $5 trillion. So when you put $5 trillion into a financial system such as ours, you're going to have a rising stock market. It definitely helped the situation. Now, another reason that the market has risen, and this chart shows that, is that economic activity has rebounded. For instance, as you can see, if you can see this chart, hotel occupancy dropped about 70% in March and April. And it's now down about 30%, but it's obviously gotten better. Another statistic shown here is that number of seated dinners, people going out for a nice evening, restaurant somewhere, that dropped obviously to 100% because everything was shut down. We're back now about 60% of where we were. But obviously, the economy is now at a key point going forward. I thought I would share a few statistics to show you how quickly that stimulus helped rebound the economy. This next chart shows that if you look at April to May, retail sales dropped 15%, but rebounded 18% in May. Meanwhile, durable goods fell 18%, rebounded 16%. Building permits fell 21%, but then rebounded 14%. So that $5 trillion, when that came into the system, that was able to help the economy rebound quickly out of the doldrums that it had fallen into. Now, there's no doubt about it, it has become a tale of two markets. We talk to our clients all the time here at Stockyards about this. This next chart shows you that certain companies, Amazon, Microsoft, Apple, Facebook, Google, they have done very well, but the general market has lagged somewhat. Now, it's back to about even, but nevertheless, some areas have done much better than others. This next chart actually does an even better job of really showing what has thrived and what hasn't. So I'll take a moment to go through this with you because I know some called in. Online retail, these are obviously trades that you would do online to get information or products shipped to you, are up 60% year to date. That is a massive increase. As well as home improvement. A lot of people have been working on their homes since they're spending a lot of time there. Information technology, groceries, and so on. But all the way to the right on the chart, energy and airlines, as well as hotels, resorts, and cruise lines are way down, 30, 40%. So unlike any time before, which stocks you own and how you've got yourself diversified are critical, and that's obviously what we try to focus on here when we help our clients. This next chart is an interesting chart, and I thought I would share it because it shows market leadership going back about 50 years. If you're old enough to remember 1970, IBM was king of the hill, AT&T, General Motors, Exxon, even Kodak. As you move forward, IBM did well until about 2000 when Microsoft arrived on the scene, and obviously Walmart started to sneak into the top 5. 2010, Microsoft, Apple, Procter & Gamble here in Cincinnati started to do well. And then more currently, you have Microsoft, Apple, Amazon, Alphabet, and Facebook. So market leadership does change, and it's one of the reasons why you need to have an active portfolio and be understanding why you own the companies you do. As an investment committee, we feel the biggest risk to these top 5 right now is regulation. There is ongoing debate that may change as we move into next year. Time will tell. So where does the stock market go now? The arrival of COVID-19 and the resulting decisions by the Federal Reserve and the government have taught us that stimulus matters. Remember, $5 trillion dwarfs the amount of money that was introduced in the financial crisis of 2008. TARP, if you remember back then, that helped the banks with $800 billion. $5 trillion makes that look like a drop in the bucket. So the point is, stimulus matters, and it can go a long way to supporting the stock market. So we feel there are 3 key drivers going forward as we approach next year. Number 1 is further stimulus. Because so many people in our country are still struggling, further stimulus is needed. And fortunately or unfortunately, the amount of government support may hinge on the election and the results to some degree. We're going to dive into that further. Jason and I and others on the committee have talked a lot about this, but the amount of stimulus is going to matter in terms of who's running the political system. The second driver that we think is key and needs to be supported and followed and understood is the Federal Reserve's new strategy. They basically are going to keep rates much lower for longer. We'll talk more about that. And then probably the third key driver is future health data. Unfortunately, in recent days and weeks, we have seen an increase in COVID cases. So I know we're all praying for a successful vaccine or therapeutics. So let's get into this a little further. Now understand that our general view, if you study history, is that you don't want to make market decisions based on elections, because if you look at this chart, which again, if you're calling in, I'll try to take you through it. This goes a chart that shows the stock market going back to 1929, and it shows it's overlapped by all the different presidents that were in office. And as you can see, generally speaking, the market moved higher. It didn't matter if it was a Republican president or a Democratic president, the stock market elevated. So it's really looking at the broader economy, and that's why we think it's basically a mistake if you try to time elections, because ultimately the broader economy is what's driving the market, not who's in the White House. Now, historically speaking, stocks have been impacted much more than who's in the White House. And this chart, again, shows you that. Other than Nixon and Bush, too, the stock market was up, whether it was Carter, Eisenhower, Truman, Obama, Reagan, the market rose. And that's because the economy, and the United States economy specifically, does well with all of its innovation. So the White House can cause a lot of distraction, but a lot of times you've got to look at the broader economy versus who's actually in the White House. So what are some possible impacts? So as Jason said, we're looking at this through the prism of a lot of our analysts that we utilize. We're not trying to show sides. We're just trying to give you some feel for what may occur. So what I've done here is on the left-hand side, again, for those of you calling in, Biden is probably going to try to have a larger stimulus than Trump. But understand something, and I think this is a key takeaway from today. whether it's 1 trillion, 2 trillion, 3 trillion, all of those numbers are larger than TARP back in 2008. So we feel that both presidents, whoever wins, are probably going to bring stimulus to the table. As we sit here today, there's ongoing discussions, and the Trump presidency wants to have a stimulus even right now. So we think even if Trump is reelected, we still feel stimulus will occur, and that is something that will benefit consumers and the economy. Biden's may be larger, so we'll have to see, but that may be a function of whether the Senate goes Democratic. A lot of unknowns there. It is clear that Biden, if he's able to, will probably try to raise taxes. But Jason and I were talking about this morning. If you really, get into how this would take place, a lot of things have to work right to change the tax code. It's not something that just happens overnight. And there are some analysts that think that even if Biden gets in and has the Senate, it may not occur till 2022. So changes in the tax code do not change quickly. So understand that as you think through things. Obviously, if Trump is reelected, there'll probably be less change in tax rates. Next category that we are looking at and monitoring is a potential increase in the capital gains tax rate. We're going to talk through that a little bit more. There are some analysts that feel that Trump may tie the capital gains tax rate to inflation, so it may rise over time, but Biden, of course, is thinking of increasing it more significantly. On the healthcare front, that's obviously front and center. Biden, I know, has come out with a new slogan, Biden Care, as it were, so there may be ongoing changes there. Trump, on the other hand, is talking about continuing to potentially try to repeal and replace, I believe is the term, the current ACA. So we'll see how this evolves, but there are differences there. And the environment, it's going to be talked about and dealt with, because consider how many forest fires are happening. Recently, we've seen that was even expanded to Colorado and other states. And of course, it seems like every other week, unfortunately, the Gulf Coast seems to deal with a potential landfalling hurricane. It's just very sad, but obviously the environment is going to continue to be looked at. Trump is generally a little less change-oriented in that area, whereas Biden would be more so. So more to come on that, I suppose. So let's look at these a little bit more in-depthly. This next chart, again, for those of you who called in, is a look at the history of capital gains tax rate increases. There are four notable ones: 1969, 1976, 1986, and 2012. In each of those cases, basically the long-term capital gains tax rate increased, in some cases as much as 5 to 10%. What's interesting is, except for 1969, the market was basically flat or higher 6 months later. Now, 1969, that was going into the oil crisis that occurred in the 70s. So the broader economy was having challenges. And it's worthy of noting that, generally speaking, if capital gains are going to increase, you could see some selling pressure before end of year, but that might be a buying opportunity, because if a large stimulus plan comes in and we have a successful vaccine, the economy will recover. So any kind of a decline you would get between now and the end of the year may be a great buying opportunity. The main takeaway from this chart is that just because capital gains tax rates are going to increase does not mean the stock market will go down. History shows us that in many cases, the market can actually rally if the underlying economy is improving. Now let's look back at the election a little bit more. So recent polls, and I looked at it this morning, I'm using Real Clear Politics in an effort to be as objective as possible. Real Clear Politics used as an average of all of the polls. So it showed Biden up by 8.9 points as of October 19th. This morning, Biden was up by 8.3. So it looks like the race is tightening a little bit. It should be noted that the battleground states have definitely been trending tighter. And as we all know, you can win the election by getting the Electoral College even if you lose the popular vote. So you've got to realize that you've got to look at each individual state. And the battlegrounds are definitely tight. And this doesn't even speak to the Senate. You look at the Senate, there are a lot of states up in the air that are very, very tight. So we're going to have to, unfortunately, probably wait till midnight or 2 a.m. election night or the day or two after to really get any indication, because this is a situation that's evolving. It should be noted that in 2016, Clinton was up by about 6 points at this point, but week going into the election, Clinton's lead did shrink. So as you follow this week, if Biden's lead is lowering and decreasing, it could be telling for kind of a Trump potential upset win, just like which took place in 2016. So we'll see. It's going to be an interesting week, to say the least. So the election will affect stimulus, and that's one of the key drivers we think going forward is the stimulus program. But the second thing, and what I've now put up, again, for those who can't see this, is the Federal Reserve's new strategy. Now this gets a little, detailed, but stay with me if you can. So the Federal Reserve has come out and said they want to seek an average inflation rate of 2%. It used to be that if the Fed felt inflation got to 2%, then once they hit it, they would start raising rates. Not anymore. The Federal Reserve is now going to seek an average of 2%. Well, this next slide shows you how the math works. If we all can remember back to our high school math, if you wanted to get to an average of 2%, you've got to have inflation running at about 2.5%, maybe 3%. This next chart actually shows you the numbers and what they've got to get to. So if you look at it on the right-hand side, there's a 3-year average over the last 3 years. It's in purple, and it shows that the average inflation rate as measured by the Federal Reserve is sitting at 1.67%. If you want to get to an average target of 2%, which is what the Fed's goal is, that means for the next 3 years, you've got to average 2.33%. So what does that mean? That means that the Fed isn't going to raise rates for years, and they want inflation to develop. They want the price of goods to cost more. So understand that that's what they're trying to do. The question is how successful they'll be, and only time will tell. Rates are incredibly low. As I mentioned at the beginning of the presentation, mortgage rates are extremely low. You can borrow money on a home now at the lowest rate possible. And this shows you that they've just come down and down and down, this chart shows. The next one actually shows you the yield curve comparison going back 7 years. This is a chart that shows that back in December 31st of 2013, you could get a 20-year treasury that paid you 3.7% every year. Imagine being able to buy that today. I think we'd all consider buying 1 or 2 of them. Now, a 20-year treasury pays you a whopping 1.2%. And one of the things that we always try to tell people, because people say, well, interest rates can only go up. But we don't know that. I think when people back then thought rates were low, they never knew they would go to 1.2%. Who's to say they can't go even lower? It is technically possible. So the third driver that we touched on is COVID. Now this chart is as of the end of September 30th, and I realize there's more data, but there is a point I want to make with this. This chart shows a 7-day moving average of COVID cases, and it also shows a 7-day moving average of, unfortunately, fatalities related to the disease. What you'll notice is when the pandemic arrived, COVID cases rose rapidly, but unfortunately, fatalities rose extremely fast. And luckily, what has happened recently, even now, COVID cases are rising, but we're becoming better at treating COVID. Fatalities are starting to rise, and we recognize here at Stockyards that they are a lagging indicator. So we're praying that they don't increase over the next couple weeks. But our hope is that with different treatments, different abilities to handle people that are under the disease, we can keep the fatality rate down, and that can be something positive to helping the economy still continue to recover. But obviously a vaccine is going to be key, as well as continued development of therapeutics. This next chart actually shows you that right now we have 4 COVID-19 vaccine candidates that are in phase 3 of clinical testing. Now that's just 8 months into this thing, So what the medical community has done is truly heroic. We owe so much to all of those people that work so hard on this because they're trying to get this vaccine done in a really, really quick, unbelievable amount of time. There have also been some successes with a term called a monoclonal antibody cocktail treatment. I believe President Trump received this, and Eli Lilly and others are trying to develop one that would help treat COVID. It is something that is still being tested and analyzed, so more to come on that. So how do you invest in a period with so much uncertainty? Well, remember, there are two things here that should give you comfort in being in the stock market. First is that there is more money coming. We've got $5 trillion. We probably got another 2, maybe 3. There are some that think at some point we'll hit 10 trillion. And when you put that kind of money in a system, it can bridge the gap. Just look what happened in March when it was introduced. The market rallied off of those lows. Stimulus matters. The other thing you got to remember is the Federal Reserve has a tremendous amount of power. There's a saying, and there's a reason it's spoken so much, is you don't fight the Fed. The Federal Reserve's power is unlimited due to the way they can run their balance sheet. So those are two strong forces that are going to provide support to the market, at least hopefully not let it drop too far. Now the wild card is COVID and how it progresses, and obviously that's something we're going to have to monitor. So with all of this, in place, what are you to do? Our recommendation is you have to have a diversified portfolio. The number one risk you can do right now is take a bet on one way or the other and miss out on some of the potential growth that may occur. This chart here shows that the amount of cash is huge on the sidelines. Yet we would argue that if you put money in, say, a 60-40 or 70-30 portfolio, you can do quite well and minimize your risk. On the right, it shows that the S&P over the last 20 years have averaged around 6.4%. A 60-40 portfolio has paid about 6.3%. But then right down below, it shows you that with a 60-40 portfolio, where you have bonds and cash, you've been able to have a lot less risk. So you've been able to get the same rate of return without as much exposure. So building a portfolio that's properly diversified is critical right now as we move into the end of the year and next year. This next chart just takes you through several years of showing you what asset class did well each year. In black, if you're able to see the chart, it shows a 60-40 portfolio, and that is done very well. It's allowed you to avoid, again, losing money, but also benefiting on the upside. So you've got to make sure you don't try to pick one area or the other. Right now, for instance, some people think they want to be just in commodities. You don't want to just be in just commodities because commodities are one of the most volatile asset classes, and they can drop just as fast as they can go up. A diversified portfolio is the correct approach. If you look to history, and that's what this next chart shows you, when you get these massive 30% declines where the market drops as it did in March, tremendous amounts, usually you're going to be in very good shape 2, 3, 4 years out. Even in 1970 and 1975, when that area was dealing with the oil crisis, that eventually rebounded as well. Our advice is if we get another pull down between now and the end of the year due to uncertainty with the election, due to, unfortunately, maybe a spike in COVID cases, that would be a buying opportunity. Because remember, more and more money is coming into the system. And we saw what it did in March, and it'll do it again. Corporate earnings, we think, may have actually bottomed. This next chart shows you that in May, that's when earning estimates were dropping, but they've now started to rise. And the market was picking up on that. And think about this. In the spring of next year, when the pandemic occurred and the earnings dropped, as you go into the first and second quarter, companies are going to have huge earnings growth over these years. So their comparables are going to be very strong because they dropped so much in the first and second quarter. So earnings may have bottomed, we feel, earlier this year as far as expectations. We do follow leading economic indicators here at Stockyards, and this chart shows in the bottom middle part about 10 of the key ones we monitor: consumer expectations, new orders, credit, stock prices, and basically 5 of the 10 are showing signs of having bottomed and starting to rebound. We'll have to follow this ongoing, but we're cautiously optimistic that we're starting to see a rebound in the economy. The stimulus is going to be needed, though, and we think, again, no matter how the election goes, we think some level of stimulus will occur. We do get a question a lot about why still use bonds. You have to have bonds to minimize your risk. It's really that simple, because if somebody incorrectly predicts what's going to happen and the market does all of a sudden tumble 20 or 30%, you're going to see a huge rally in bond prices. It's your stabilizer. Think of it as that anchor for a boat out in the middle of the ocean. It keeps the portfolio in place. You must own bonds. You don't want to have just cash, because even with rates low, you're still earning some level of interest on a properly diversified bond portfolio. Investors' time frame is the key. This is a chart provided by JP Morgan that shows rolling averages, meaning if you take any rolling period, 5 years, 10 years, 20 years in length, as long as you have enough time in the market, you're not going to lose money based on history. And we think that is very important to remember right now in these uncertain times. I included this chart because, as many of us say, each generation faces tremendous challenge. This chart, for those who can't see it, goes back to 1900. It shows some of the unfortunate events that our country's dealt with. World War I, the Great Depression, World War II, stagflation, Vietnam in the 70s. And basically what you see is, though the market had periods where it was volatile like it was, overall America is a country that stands for innovation, creation of ideas, an expanding economy, and our population is only growing. So consumer spending will continue to grow over the long term. So with that, I'll throw it back to Jason to continue our discussion about what's taking place with the upcoming election in the estate.
Perfect. No, thank you, David. Appreciate all the comments there. I did want to, with everyone that's listening, kind of as I start off, share with you the things to look forward to. Let's not forget about that. In about 8 days, you can watch TV without seeing, I don't know, how many dozen political ads. Hopefully your text messages for political votes will go away. Your mail will probably be 3/4 less because we won't have all the trash in the mail. So those are the things to look forward to. Let me just pull my slides up. Didn't come up the way I anticipated. I've recognized a lot of you on the call today, a lot of familiar faces to our monthly. Again, for those of you that are new, my name is Jason Hamilton. I'm the manager of financial planning and an investment advisor here in the Cincinnati branch. I'm going to take you today through a little bit of estate planning and tax thoughts. And again, as I mentioned earlier, this is more or less potentially some worst case things. There's a lot of unknowns out there. And as a wealth management group, myself as a financial planner, we try not to predict the future, but we try to plan for it. And we do our best to plan for things, and it doesn't always work out the way we want. I've spoken with a few attorneys over the last couple days, weeks, and trying to pick their brain on how they're preparing for year end. And a lot of them, they have a little bit of a different thought. They're more reactionary these days. They've seen so many changes from past presidents that they've tried to plan for what they thought was coming, and it didn't work out the way they thought, and they've created a waste of time or an expense that some people didn't need. So as we go through this, just keep in mind, we've got some things to work through before we know exactly what's going to happen. But the viewpoint from what I'm saying today is I'm making the presumption of what would things look like if Biden was elected and Trump went out of office. Because we know, like I mentioned earlier, just kick this off, we know what President Trump brought to us for the last 4 years. We have a pretty good idea of what the next 4 years under him would look like. But under a Joe Biden, President Biden, it kind of brings us to a spot where we should start planning a little bit, not necessarily doing anything just yet, but have a plan in place. And whether we see a change of presidents or not, what we're going through is a great reason for at any time just to go back and let's review some things. Review your estate plan, but maybe even more importantly is review your investment portfolio allocations and capital gains. Look at your risk that you're taking. If the year 2020 for you has been a little too much to stomach, your investment portfolio, the allocation within it might be something to have a conversation with your wealth advisor about. Because, the one thing we can assure you is that the volatility of 2020 probably is not going away anytime soon because of COVID and a potential change of presidents. So we expect that to remain. Also, right now is a great time. Still some unknowns out there, but, review your income. Where's your income coming from? Can you defer any income? If you're in a position where you can force income into 2020 and not let it carry into 2021, those are things to maybe possibly be thinking about under a new president and potential changes. I do want to highlight a couple of things, because there's a lot weighing on, let's just play this out and Biden is elected and the Senate changes and it's a Democratic majority also. One might easily think that everything under President Trump's Tax Cuts and Jobs Act from 2017 automatically is going to be abolished and go away. That's actually not the case, and I don't want to get too into the weeds because, one, I'm not smart enough, two, I don't remember my government class well enough, but I do know from the Tax Act that there's a filibuster in place, and that takes 60 votes to abolish. Now, I know there's some loopholes and things that they can work around to change that, but that is a little bit of an assurance, potentially, that if President Biden is elected, Democrats take the Senate, it's not going to change overnight necessarily on some of the estate pieces and tax pieces, and we'll go through that. But I did want to address that. They're going to have some work. I think we'll see a lot of gamesmanship there in the political system, maybe some new things that we've never seen as they try to get what they will want to get out of this. So with that being said, what we do know, if you try to read, and it's been changing rapidly day by day, but Biden's economic policy, as it's stated today, he's got about $7 trillion worth of spending built into that. And like I said, that changes day by day. I think that number is probably closer to $9 trillion if you read through and get a consensus of what other people have been pulling together and tallying. His plan, though, is to have $4 trillion of that covered from additional tax revenue. That will be the tricky part. Will you be able to recover $4 trillion and get things passed through the way that they're hoping? Obviously, the way his plan is being presented as policy today, if it were passed in the law, taxes at the corporate level and higher income households are going to see a significant change overall, bottom line, no doubt. Could be, a little bit more subtle. It could be a little bit more instantaneous. We're not quite sure. But we do know most of the revenue would be captured from the rollback of President Trump's tax cuts from 2017. Considerations under a new administration for estate planning, worst case, again, if things happen more quickly than thought. Currently, the gift and estate tax exemptions are, about $11.6 million per person for exemptions that you can pass tax-free. That's something to kind of look at. Those are the highest levels we've ever seen. What we would feel very confident in is if President Biden and his administration is able to accomplish what they want, their goal is to roll that back to pre-2017 levels, about 5.8, and possibly as low as 3.5 million. That range between the 5.8 and the 3.5, that's up for debate. It's often been said that he wants to get to 3.5. Not quite sure that he gets all the way down there, but we for certain would feel that it's going to go back to pre-Trump. So if you're being overly cautious, you might want to start to plan out a way of how can I maximize my benefit for the end of this year. And it may not be something you actually have to accomplish this year. We'll know more, hopefully, by the end of November. That's also consideration, is how quickly are we going to know who the new president is. But we'll have some time to plan. Question will be will your estate planning attorney have time to get things done quickly if needed? Hopefully we'll have 2021 to kind of be able to work on some things and things not revert back to January 1st of 2021 should they be able to accomplish what they ultimately want to accomplish. Let's say you didn't get something accomplished in a timely manner, you missed your exemption, or I should say you forgave a large amount of the exemption because you didn't capture it with the changes coming, and it happened abruptly or quickly or more quickly than you're able to address it. There are some things that you could still do in the future. And this is more, I'm speaking to, pretty affluent households here. Not for everybody, but they do have grantor retained annuity trust out there, charitable lead trust out there. Those are strategies where you can put assets into trust. You as the grantor putting that money out there, you can take the income out, but you're taking monies out of your estate. And specifically, you're usually funding it with assets that you think are going to appreciate, obviously, and it's going to pass tax-free. You've taken that growth out and sheltered it, but still be able to capture the income. Same potentially defective grantor trust, a little bit more complicated version of a trust. Same concept, though. You're trying to defer growth or large capital gains and take income, but pass it on to usually your children, grandchildren, and out of your estate. So you will have options if you should miss something. The goal is, as I had referenced earlier, the title of this is let's start planning and being ready for the worst case, hoping that maybe that doesn't actually hit us, but you'll be ready and have a plan in place. When it comes to taxes, proposed income tax changes from Biden's policy is essentially what we do know. $400,000 in income or higher, you're going to see a higher tax bill, no doubt, at some point when he gets his policies through and into law. It's still a little unclear, the thresholds on individual versus joint filers. Is it going to be 400 for each? Is the single filer going to have a different number? Not quite sure. Through these slides here, I'm just presuming that both classes will be at 400,000 and higher. You're going to pay more taxes. And when I say more taxes, again, we're going back up to the 39.6 tax bracket, and it's going to happen more quickly than it has. So you hit $400,000 in income, and then there's a chart coming up here. You're going to quickly climb to that 39.6. If you're under that $400,000 of income, I should have put parentheses around this, you should remain unaffected on taxes. Again, don't know until we actually live through this, but right now his policy in place that he's kind of written out there does not affect those making less than $400,000. Things to be looking at that would be changing that could definitely should be taken into consideration is long-term capital gains and qualified dividend rates will increase also to ordinary income tax levels. So that's essentially you're paying double the tax. And again, this is going to be for more affluent households. $1 million or more right now is the target for seeing those increases. So capital gains, for those that have significant capital gains out there and not a whole lot of carry forward losses, you might be looking at a strategy of how do I want to harvest those gains most tax efficiently, and I'll talk a little bit more about that too. And then, the proposal to eliminate the step up in basis. So if you inherit assets from a mom or a dad or a grandparent or just another family member, you normally get a step up in basis, and to keep it simple, it's usually based off of the date of death of that individual who's passing assets on. There's the proposal to eliminate that. There is some conflicts with that. So we have a lot of older, affluent individuals out there, and they've got legacy assets that have held for decades, and they don't have a cost basis, and it complicates, what's that basis that's going to be pushed forward to the heir. how they figured that out. And, there's a prudent way of figuring that out, but it does complicate the system. There's also the other side of this proposal that it's more of a death tax on those taxable accounts. When that individual passes away, the account is treated as if it was liquidated, and you're going to pay the tax on the gains, and then it gets passed through the air, and then essentially it's gotten their step up, but the tax will be paid at death. This has been, I referenced on here on my slide deck here that this maybe is not as likely to happen, but here in the last couple of days I've read that maybe that's not the case. So to be determined, but something to be thinking about. And why that's important is that, a lot of individuals who had sizable capital gains, rather than sell it, their plan in place was, hey, I'm just going to live with it. I'm going to manage that gain out there so that when I pass, my son or daughter, whoever's inheriting it, they're going to get the step up, and then they can diversify, potentially diversify a concentrated position. Here in Cincinnati, we see that a lot with Procter & Gamble or Cincinnati Financial, maybe a little bit of Fifth Third stock and scripts and things like that, where there's large amounts of appreciation, and they just kept it sitting out there. And that was kind of their estate plan, is, hey, I'm going to die and I'm going to pass on a step up. But now there's a chance that they'll have to manage that a little bit more diligently moving forward because of the potential loss of a step up. Here on this slide, again, the comparison of tax brackets potentially. You can see married, filing jointly, and individual, current on top, and the proposed Biden tax plan on the bottom. Again, this shows that $400,000, whether you're single or jointly filing, that's going to be the threshold. Under the proposed plan, you're going to go from 32% tax bracket at $399,000 to, if you cross over $400,000, those monies above and beyond that are going to be right up to 39.6. So that's a pretty quick jump as compared to what we're currently living with and how you're taxed. Same kind of effect on an individual. You're jumping straight up from your 35% tax bracket, so you'll hit the 35% tax bracket as an individual filer at $200,000, and you'll jump up to 39.6 once you cross that $400,000 of income. Again, this is just what we know. We're doing our best to decipher information out there. Admittedly, some of Biden's policy is not quite clear. There's a lot of things just being thrown out there, and we don't know exactly all the fine details behind it, and it changes here and there a little bit. There are some enhancements to his tax plan that would essentially could be helpful, and that's through tax credits proposed. So child tax credits could potentially increase from $2,000 to as high as $3,600 for children under the age of 6, and then for all other children under the age of 17, it would be $3,000 for each of them. Another significant increase would be your child and dependent care credit. That would, under the proposed plan, would move from $3,000 for one child up to $8,000. And if you have 2 or more children, it's going to move from $6,000 up to potentially $16,000. So that's a pretty substantial move. The first-time homebuyer credit is to be reintroduced also. It's a credit up to $15,000, so that is out there in the policy, is coming back. And there's also a proposed caregiver credit of $5,000 for infirm or long-term caregivers, and I believe that's directed to, there's so many, children taking care of their older parents, that there's a credit out there for that. Other proposed changes, this is for, business owners out there. So the elimination of the qualified business income tax deduction. If you're over $400,000 in income, that you'd lose that. So that's your partnerships, LLCs, your S corps, sole proprietors, and that potentially losing that tax deduction out there is potentially a 10% tax increase to you. So, as you're battling through all your other tax increases, you're going to see potentially a 10% tax increase from this. I mentioned, you're getting some benefits potentially if you have children and higher deduction amounts there, but some things as far as when you're taking your itemized deductions or how you're getting deduction credits, there are some changes that are not going to help those that are in higher tax brackets, and that's the flat retirement contribution credit. So if you're contributing to a 401k, largely that's going to be where this will really come into play. If you're lucky enough to be making a tax deductible IRA contribution, this will also impact you. But rather than get that off, have that deduction offset income, they're just going to give you a 26% deduction credit. So if you contribute $10,000 in your 401k, you only get a deduction of $2,600. For higher income earners, that's going to change potentially the thought process of a Roth 401k versus a traditional. You're not going to get nearly the offset you used to get. Same kind of thing will play out with itemized deductions. So the thought process is if you make less than $400,000, you're probably not itemizing. I would argue that, you know, although there's policy out there, that's their thought process. But you know, probably that $200,000 to $400,000 household, they're probably itemizing more than thought, and they're going to get hurt by this a little bit. But that's, you know, up for debate and further discussion. But itemized deductions will be capped at 28%. Hurts those individuals above the 28% tax bracket. They're going to have less deductions to offset income. It's said to be little to no impact in the lower tax brackets, but like I said, I would argue between 200,000 and 400,000, and certainly some individuals below 200, they're still offsetting and having itemized deductions, but their thought is that your itemized deduction, you're already taking that, so your 28% cap won't have much of an impact to you. Other proposed changes, you know, a big one is corporate tax rates. They're going to increase from 28% up to 28% from 21. Not as high as it was at 35% just a few years back, but still a significant increase. Not sure that necessarily changes company earnings significantly enough. I've read it both sides there. You know, companies have relatively been pretty strong and they can weather a 7% increase, but it's certainly going to be damaging to economic growth to some degree, but, you know, potentially not. And then a lot of you may be unfamiliar with this, but 1031 exchanges was a tactic to defer capital gains. If you were someone that has done those in the past or was looking forward to potentially do that with some property or investments that you have out there, those will be eliminated for those that are making more than $400,000 of income. So you won't be able to exchange your, you know, like-kind property for another and offset and carry forward gains into the future. That will be abolished and would potentially go away. You know, so planning for year end and beyond, and again, I'm going to reiterate and say, you know, worst case. A month ago, I was a little bit more concerned that potentially this was going to come at us faster or at a pretty quick pace, and we're going to have to do things pretty quickly. Now I'm starting to wonder, you know, if something can be accomplished in as quickly as 2021, should the Democrats take full control. But with that in mind, again, like I said, this is all about planning and being ready for the what ifs. So if you need to take action, you know what to do. Things to be looking at is whether it's this year or next year, taking income sooner than later could certainly be a tax efficient way through the future. So if you're a professional working in a publicly traded company, you have non-qualified stock options, you might, and they're in the money, you might look at taking and cashing those out rather than waiting. So essentially, these are just strategies for accelerating income, what we think is going to be a lower tax bracket, tax burden. Roth conversions probably should be considered, will probably be a popular thing if we do know taxes are going up and when that is. So individuals will probably take advantage of Roth conversions at a lower tax bracket and let that grow tax-free, tax-deferred out into the future. You know, capital gains is going to be something that will be talked about quite a bit, and, you know, when you harvest those, and that's another thing to look at is, you know, do you accelerate gains in 2020 or 2021 if and when we know that rates would go up, and then how would you manage those gains moving forward? You know, largely David with our clients in Cincinnati, and your investment advisors in Louisville and Indianapolis. When we're sitting down with a client that has large capital gains, we talk about that on an annual basis and how do we get out of that efficiently. And that'll be something that you want to definitely put an emphasis on. So you might have had a more aggressive strategy for taking capital gains, and in a higher tax environment, especially if you're over that $1 million and above in income, it's going to probably change your strategy of how you're going to harvest capital gains. And then, the use of municipal bonds for clients will probably tick back up. It kind of stalled a little bit, or I should say wasn't as necessarily as popular as it has been in the past, because you could own taxable bonds, and if you can, based off of your marginal tax rates, kind of broke even and grabbed a higher yield. And the municipals didn't really matter so much, but now it might actually make sense to potentially own more municipal bonds to manage taxes. You're going to have to be efficient with dividend paying stocks too. Again, I'm directing this to high income earners. What we think to be above 1 million, certainly that could change and maybe it ends up being lower, but you're going to look at where you're putting those dividend paying, those income paying holdings. It might make sense if you have a number of buckets out there. Maybe you have a Roth account already, you have a traditional IRA account already, and you have a taxable account. You might shift where you kind of hold assets depending on what they're paying and the income and what your tax bracket is and what your tax burden is. And as I referenced earlier, contributing to a Roth Roth 401k might make more sense for the high income earners. So if you were already torn about it or not quite sure what to do with it, this might make it an easier answer. And if you're in the upper tax bracket there, contributing to the Roth is going to be more beneficial. You're not going to get nearly as much of a deduction today as you normally would in a traditional 401k contribution. So you might as well take it and put it into a Roth and let that grow tax-free. The CARES Act that came out in March, about $2 trillion plan, had some charitable gifting in there so that you can maximize gifts. And it could be something to look at. If you have cash on hand, the CARES Act is allowing you to make cash donations directly to a charitable organization and take 100% of that to offset it towards your adjusted gross income. And if we thought things were going to happen more quickly, that might be something that you do to minimize or completely reduce your tax burden for 2020, knowing that you're going to have higher taxes in the future. And then again, I've said this already, there's no better other time than now to, review your estate plan, just review your tax situation, where the money's coming from, but not just this year, but, look out a couple of years into the future, 3 to 5 years. Where do you think you're going to be? How's that going to affect your taxes so that you can be more efficient moving into the future? Again, I've taken you through this as kind of a worst case scenario. We want you to be planning for maybe potentially drastic changes, hoping that it won't be as drastic as what we're outlining. Like I said, there's the filibuster out there. My interpretation is that will be a little tricky for them to overcome, but there's some gamesmanship strategies already out there being talked about of how they would try to overcome it. And it'll be an interesting couple of months under a new president, and an interesting 2021. So with that being said, certainly appreciate everyone that was on the call today and has tuned in. I hope you're able to follow along well if you're on the phone line and not on a computer. If you would like a copy of this presentation, reach out to your wealth advisor. We'll get you a copy of the presentation for you to see if you weren't able to view it. Otherwise, we want you to keep just thinking about things and trying to eliminate being or having to be too reactive in the future. And by all means, hopefully that's not the case. And whether President Trump stays in office or we have a President Biden, hopefully things come at a pace that we're able to handle. And certainly for the estate planning attorneys out there that I know that are concerned about what their workload is going to look like, that would certainly help. With that being said, I'll open the phone lines up, *6. If you have a question for us, you're more than welcome to chat a question if you're on the computer, and we'll address those. If you have any questions, you can always reach out to your advisor. You can email us at, let me pull that back up so you can see it, at wmtquestions@syb.com, and we'll get back to you right away with that. I'll give you just a moment for those that are out there that might have a question. Well, it doesn't look like anyone's coming through with any questions. Again, I want to appreciate or send my appreciation off to you that for joining. Hopefully you got something out of this. In the future, when you get these invites and you know, there's someone close in your network that you know that you think might benefit from this, by all means, forward that out to them. I'm happy to have anyone join us. Again, we appreciate your business if you're a Stockyards customer already. You know, we take each client, you know, very, very seriously. They're all very important to us. And being a small community bank, you know, we appreciate each and every one of you. Again, I hope you enjoyed this last week of October. We've had a beautiful fall. Get out there and enjoy it. And like I said, remember the bright side of all this is the political ads, the junk mail, the text messages, those all do go away in 8 days, but it doesn't mean anything's getting any better after that. So have fun with it. Try to enjoy it. As you know, we can only take day by day, and reach out to a wealth advisor if you do have any questions, and we'll certainly walk you through a strategy that we think is best for you. With that, be on the lookout. We'll probably put something together in November, depending on how the election plays out. And then certainly in December, we'll have another monthly WebEx series out there too. So take care, everyone, and thanks again.